The way that I pick stocks, whether it is for swing trading, whether it's for day trading, I will pick stocks based off of a system that I've created over the years that I call E.A.G.L.E. Now, this system has evolved from a lot of different places. I've studied O'Neill, I've studied Minervini, I've studied Darvis, I've studied Livermore, I've studied a wide variety of traders, Van Tharp, and over the years, I've accumulated knowledge from all these great traders, from different trading books, from different seminars that I've been to, and the way that all successful traders that I've seen, all professional traders that I've seen, nobody is trying to be a clone of anybody else. Everybody is taking a little bit from here, a little bit from there, a little bit from there, a little bit from there, and eventually they come up with their own thing. So they're modeling success from others, but they're not trying to be a carbon copy of success of anybody. That's something that took me a while to figure out on my own, but eventually this is what I came up with, right? So the system that I have, it's called E.A.G.L.E. Now, E.A.G.L.E. is an acronym. It stands for the 5 things that stocks that have made extraordinary runs. I'm talking about 500, 1,000% or more in a very short period of time. Stocks like Facebook have made this, stocks like Beyond, stocks like Apple, right? They've all had these kinds of qualities, right? So the E. The first E stands for extraordinary earnings, sales, and or projections, right? So I want at least one of those to be present in the stocks that I'm going to trade. So, what's extraordinary earnings? It would be at least 25% or more quarter over quarter over quarter, right? And if it's accelerating quarter over quarter over quarter, even better. Then I want sales. Sales to be 25% or more quarter over quarter over quarter. The more, the better, right? But it needs to have one or the other. It doesn't it doesn't necessarily need to have both. If it has both, amazing, but if it has one, good enough. Now, let's say it doesn't have any earnings or sales, then the way that I would still look at it, if it has projections that are more than 25%, right? Like if the projections are completely off the charts, then that would be something that I would be interested in. Take a look at any of the biotech stocks, right? Like biotechs tend to not have any earnings or sales because they're still in the developmental stages, but you see them have these extraordinary runs. I want to be available for stocks like that. So it's rarer that I'll be in those kinds of stocks, but I want to be open to that kind of possibility. The A. The A is for aim. You want to aim for high probability, high reward to low risk setups. So what does that mean? Historically, stocks have set up in different base patterns. How do those base patterns form? It's all based on psychology, right? You could see hope, fear, greed, all these things manifest themselves right on the chart, right before your eyes. And if you're aware of what the price consolidations look like and the timing of them and where they're forming in relation to the chart's own historical price action, you could really pick up on what the mind of the market is on that stock at that time and be able to capitalize on it tremendously. Whether you are a long-term swing trader, day trader, that it applies, right? So I'm using it for all that. And so I'll look for these consolidations, I'll wait for it to tighten up, and then I will get in where I could get in real close to my entry point and to my exit point. And the exit point, that where I'm placing that stop loss, is even more important than the entry point, because I think of that first stop loss, that's the floor, right? So if I am standing on a floor, I want that floor to be real sturdy. Like if there's not multiple layers of support right there, then it's kind of like standing on wet cardboard, right? Like it's just a bad idea. You want your floor to have multiple levels of support, so that way it's nice and firm, and if it does break through, then yeah, there's no question. You don't want to be in that trade anymore. And you want the potential where if you do have a very tight entry point and exit point, then it doesn't take that much to have a high multiple trade where that you could hit a 4R, 5R, even more R return, where you're risking $1 and you're making potentially $4, $5, $6 off of that one trade. So that's the A. Then the G is for growth. I want there to be something growing in this stock. I want the industry to be growing. I want there to be some product that's growing. Maybe a new sector is growing, right? Like I mentioned earlier, beyond Apple, Facebook, all of them created something extraordinary, right? And that's what helped their share prices take off. The L is for leadership. So I want the stock to be a leader both in the market, right? So the relative strength is going to be very important. Relative strength versus the S&P 500, that's what I'm looking at. And I want it to be a leader among its peers, right? So I'll take a look at all the stocks within its industry group and see how does it fare among the other stocks. Are the other stocks outperforming? Are they underperforming? I want to be in the leader. And the last thing, one of the most important things too, is the overall environment. I want to be trading with the market. If the market is in a strong bullish uptrend, then I want to be trading stocks that are in a strong bullish uptrend. If the market is in a bear market and everything's falling, then I want to be shorting stocks. It's a lot easier to trade with the overall market than against it. If you're trading against the market, you're kind of like that salmon that's trying to swim upstream and it ultimately gets eaten by the bear. You don't want that to be you. You want to be swimming with the market, and it makes your life a whole lot easier. And that's how I find stocks that I want to trade.